At 2:32 p.m., on May 6, 2010, a mutual fund didn't panic sell. It delegated the panic to an algorithm. 75,000 E-mini contracts, about $4.1 billion worth, were fed into the market by a sell program that didn't care about price, didn't care about time, and didn't pause to ask a human if this was a good idea. And within minutes, the entire U.S. stock market started acting like a machine having a seizure. If your retirement is in an index fund, if your rent depends on your job, surviving the next recession, if you've ever wondered why the market feels like it's run by invisible hands, you should be uncomfortable with what happened next. Because today, Wall Street isn't just automating execution, it's automating judgment, and the same kind of feedback loop that almost broke the market in 2010 is being rebuilt, this time with artificial intelligence sitting closer to the steering wheel. The IMF is already warning that AI could increase market speed and volatility under stress, especially if models respond to shocks in similar ways, or shut down when something happens that they weren't trained for. So here's the obsession that won't let me go. What if the next crash doesn't start with a mortgage or a bank or a war, but with a perfectly rational machine making the same decision as 1,000 other machines at the same time? And if that happens, how much of your personal finance problem is actually personal, and how much is engineered? By the end of this story, you'll be able to recognize 5 specific crash patterns that show up in 1929 and 1987, in the dot-com era, in the 2008 meltdown, and now in the AI boom. You'll see exactly where the pressure is building, and why the most dangerous part isn't the technology. It's the way the money around it behaves. Financial crashes don't usually announce themselves as crashes. They announce themselves as progress. They announce themselves as a new era, a new tool, a new kind of company, a new kind of economy, something that makes the old rules feel outdated. Sometimes the new thing is real railroads, electricity, the internet. That's what makes bubbles dangerous. They're built around something that actually changes the world. The lie is not this technology is fake. The lie is this technology can't be overpriced, or worse. This time, risk has been eliminated. Carmen Reinhart and Kenneth Rogoff call it the "this time is different" syndrome. The seductive idea that old constraints no longer apply, right here, right now. Their work shows versions of that same story, repeating across centuries of crises. AI is the latest version of that story. In 2024, Stanford's AI Index, one of the most data-heavy trackers of the AI economy, estimated corporate AI investment at $252.3 billion, and said private investment in generative AI reached $33.9 billion in 2024, more than 8 times the level in 2022. And it's not just money. It's adoption. In that same report, the share of surveyed organizations reporting they use AI jumped to 78% in 2024, and the share using generative AI in at least one business function more than doubled to 71%. That's the headline. Everyone wants to believe AI is everywhere. Therefore, the boom is justified. At first glance, that sounds reasonable. But there's a catch. Crashes don't happen just because people are excited. Crashes happen because excitement gets converted into commitments, contracts, debts, leverage, promises, and then the world refuses to behave as predicted. And the AI boom has already started converting hype into hard commitments. Gigantically expensive data centers, long supply chains, concentrated dependence on a few chip makers and cloud providers, and even more. Quietly, the integration of AI into financial decision-making itself. The Financial Stability Board, which exists for one grim purpose, watching the world for systemic risk, warned in 2024 that AI can amplify vulnerabilities that increase systemic risk, including third-party dependencies and service provider concentration, market correlations, cyber risks, and model risk. It also flagged something you should not ignore. Generative AI increases the potential for financial fraud and disinformation in financial markets. So no, this isn't AI bad. This is the AI boom is building a familiar kind of fragility. To understand why, we're going to do something that feels almost offensive to modern optimism. We're going to treat the AI boom like a crime scene. Not because we know there will be a crash, but because the last 4 or 5 times, we said this is the future. We also said it's different this time. And we were wrong. Here are the 5 ways the AI boom is repeating. The mechanics of the biggest financial crashes in history. The first pattern is always psychological, because the crash begins in the part of the system made of brains. It's the new era story, a narrative so powerful that it turns skepticism into social embarrassment. In the late 1990s, that story was the internet. The Nasdaq rose 86% in 1999 alone, and by March 10, 2000, it peaked at 5,048. Investors talked about the new economy, as if profits were optional because the network was the product. Goldman Sachs, hardly a nostalgic historian, describes how the AOL Time Warner mega merger seemed to validate that belief right before the bubble imploded. Even earlier, in December 1996, Alan Greenspan, then the Federal Reserve Chair, didn't say bubble. He asked a question that became famous precisely because it sounded like an adult. Interrupting a party, how do we know when irrational exuberance has escalated asset values, making them vulnerable to unexpected and prolonged contractions? That question is a crash pattern on its own, because bubbles aren't primarily about numbers. They're about permission. They give otherwise cautious people permission to suspend the part of their mind that says, what if I'm wrong? AI is giving that permission right now. The story sounds like this: AI will replace work. Therefore, AI will replace scarcity. Therefore, the companies building AI deserve to be priced like gods. There's a reason central banks keep using words like FOMO when they talk about AI-linked stock valuations. The European Central Bank has warned that major U.S. tech valuations look stretched, and that fear of missing out is part of what's driving prices. Here's why that matters when the social emotion isn't greed, but fear of being left behind. You get a bubble that feels moral, not just profitable, necessary. And that's how the first trap is built, not by scammers, but by sincere believers who feel like skeptics are simply too slow for history. The second pattern is what the new era story does to market structure. It concentrates attention, then it concentrates money, and eventually it concentrates your risk, even if you think you're diversified. Right now, the AI boom has a face. Actually, it has 7 faces. By the end of 2024, the Magnificent Seven were reported to represent more than a third of the S&P 500 and nearly a quarter of the MSCI. World an extreme level of dominance for a handful of companies. If you own a broad index fund, you have a relationship with these companies whether you meant to or not. This is one of the most underrated dark mechanics in modern capitalism. As investing became passive, risk became crowded. Market cap weighting doesn't just reward winners. It forces everyone, pensions, retirement accounts, ordinary savers, to own more of what's already gone up. The same winners become bigger, the index becomes more dependent on them, and the market starts to mean whatever these few companies do next. That is how diversification turns into an illusion. And history has seen this movie before. In every major late-stage bubble, leadership narrows. The narrative becomes a small set of symbols: South Sea shares, railroad trusts, dot-com darlings, AA mortgage paper. The crowd piles into what feels safest, because it's what everyone else is buying. The crash is never everything fails. It's the thing everyone owns stops going up. Here's an uncomfortable question: if 7 companies can pull the entire index around, like a dog on a leash, what happens when the AI narrative inside those companies hits its first real disappointment? Not a bad headline, a real, boring, quarterly disappointment. CapEx too high, margins too thin, customers hesitating. The answer is that the crash stops being a problem for tech investors. It becomes a problem for anyone whose money is tied to the index, meaning basically everyone. And that takes us to the third pattern, where bubbles stop being stories and start becoming concrete. The third pattern is the building spree. In a boom, capital doesn't just chase profits, it chases capacity. If you want a single number that captures how hard the AI hype has already been converted into physical reality, look at the scale of data center spending. In 2025, Barron's reported that Amazon, Microsoft, Alphabet, and Meta collectively spent over $400 billion on AI data centers, and that spending was expected to rise further in 2026. And when Amazon talked about its own plans, it wasn't subtle. In early February 2026, AP reported, investors recoiled when Amazon said it planned to raise capital, spending to about $200 billion focused on AI, robotics, semiconductors, and satellite technology, prompting a sharp after-hours drop in the stock. That's not a startup blowing venture money. That's one of the largest corporations on Earth, telling the world we're going to pour a mountain of cash into the idea that AI demand will keep swelling. This is where bubbles get dangerous, when the future becomes a construction project. Because the moment you build the thing, you have to keep selling the story. Data centers aren't like software. You can't just pivot a gigawatt-scale server farm the way you pivot a mobile app. You sign long leases, or you buy land, or you issue debt, or you lock in multi-year contracts. You commit to pipelines of chips and racks and networking equipment. You hire teams. You attach entire regions to a massive load of electricity and water. And then quietly you become fragile. Not because you're weak, because you're committed. The International Energy Agency has been blunt about how physical this boom is becoming. It estimates data centers consumed about 415 terawatt-hours of electricity in 2024, about 1.5% of global electricity demand, and says that global data center electricity consumption is projected to double to around 945 TWh by 2030. In its base case. Read that again, double. That isn't just tech. That's energy policy, grid expansion, permitting wars, local politics. It's the kind of stuff that moves at the speed of bureaucracy, not the speed of innovation. And when a fast industry collides with a slow bottleneck, the market does something ugly. It starts pricing fantasies as if they are already built. You've seen this before, even if you didn't notice. In the dot-com era, there was a parallel bubble. That didn't get the memes telecom. The world laid fiber, built networks, ran ahead of realistic demand. Then demand didn't arrive as quickly or at the price people hoped, and a lot of that capacity became a painful, debt-financed monument to optimism. AI infrastructure has the same smell, breathtaking investment, justified by projections that assume adoption curves will be smooth. And monetization will be inevitable. But inevitable is not a financial plan. And here's the part that makes this pattern nastier in the AI boom. The spending doesn't just risk a correction. It risks changing the financial DNA of the companies doing it. If a company spends tens or hundreds of billions in CapEx, it doesn't disappear from the income statement. It shows up as depreciation. It shows up as lower free cash flow. It shows up as pressure to keep growth high enough to justify the build. When money is cheap, that pressure hides. When money is tight, it bites. So the third pattern is this: a boom turns into an infrastructure bet. The bet becomes debt, depreciation, and expectations. And the moment reality underdelivers the answer is rarely calm repricing. It's panic. Now, at this point, you might be thinking, okay, this is just another tech bubble. Like .com. But that's where the story gets darker. Because the AI boom isn't only being financed by the financial system. It's being installed inside the financial system. This is the twist most people miss, because it's boring compared to chip launches and billionaire CEOs. The financial system doesn't just fund bubbles. It learns from them. It builds tools. It automates. It searches for any edge. And right now, financial markets are adopting AI not as a theme, but as an instrument. IOSCO, the global body that coordinates securities regulators, reported in 2025 that firms are increasingly using AI systems to support decision-making in robo-advising, algorithmic trading, investment research, and sentiment analysis. The IMF's October 2024 Global Financial Stability Report went further. It said evidence suggests AI adoption in capital markets is likely to increase significantly, and that AI could cause large changes in market structure through the greater and more powerful use of algorithmic trading and novel trading and investment strategies. It also warned that new risks may arise, including increased market speed and volatility under stress, more opacity and monitoring challenges, increased operational risks. As a result of reliance on a few key third-party AI service providers and increased cyber and market manipulation risks. And the Financial Stability Board again, the people paid to worry-listed AI vulnerabilities that stand out for their potential to increase systemic risk, third-party dependencies and service provider concentration, market correlations, cyber risks, and model risk. So here's the reframing. If the dot-com bubble was big money betting on new companies, the AI boom is big money betting on new companies, while simultaneously wiring new machines into the decision systems that move big money. In other words, the boom isn't just in the asset prices. The boom is in the control layer. And once an idea becomes part of the control layer, part of how trades are executed, how portfolios are balanced, how risk is priced, its failure doesn't just hurt investors. It can distort the entire market's behavior. Which brings us to the fourth crash pattern: automation as an accelerant. On October 19, 1987, Black Monday, the Dow Jones fell 22.6% in a single day. That sentence sounds like ancient history, like a weird old story from the era of shoulder pads and smoking on airplanes. But the cause is painfully modern: a feedback loop created by automation. In the 1980s, portfolio insurance was marketed like safety. The idea was to use rules often executed through futures and program trading to limit losses as prices fell. Rules sound comforting. Rules feel like control. The Brady Report, commissioned after the crash, describes how portfolio insurance sales overwhelmed rallies and intensified selling pressure. It documents, for example, that between 11:40 m and 200 p.m., that day, portfolio insurers sold about 10,000 futures contracts, about 1.3 billion, representing about 41% of futures volume, excluding market makers. And that portfolio insurers added billions in selling pressure across stock and futures markets. Then came the fatal ingredient markets disconnecting. As futures fell faster than stocks, a huge discount appeared. That discount didn't reassure anyone. It terrified them. It told prospective stock buyers in real time that something was broken, and further declines were coming. The Brady Report describes how heavy futures selling continued by a few portfolio insurers late in the day, and how the Dow sank almost 300 points in the last hour and a quarter to close at 1,738, down 508 points, almost 23%. That's the anatomy of an automated crash. Not one villain, not one cyber attack, not one conspiracy. Just a set of rules that were rational individually, but lethal when synchronized. Fast forward to May 6, 2010, the flash crash. Again, it started with thinning liquidity and negative sentiment. And then, again, a large sell program hit the market through automation. The SEC and CFTC's report is surgical about this. At 2:32 p.m., a large fundamental seller initiated a program to sell $75,000 e-mini contracts, about $4.1 billion a hedge. The seller chose an automated execution algorithm targeting 9% of trading volume, but without regard to price or time. That phrase, without regard to price, is the part you should tattoo on the inside of your eyelids, because it describes the moment you stop participating in a market and start participating in a machine. Now take that historical pattern and insert modern AI. IOSCO says AI is being used for algorithmic trading and decision support. The IMF warns that under stress, speed and volatility could increase, especially if AI trading strategies respond to a shock in a similar manner, or shut down in response to an unforeseen event. At this point, you don't need to imagine Skynet. You need to imagine something simpler: a crowd. Not a crowd of people, a crowd of models, trained on similar data sets, optimized for similar metrics, running on similar cloud infrastructure, watching similar signals at microsecond speed. And when the signal flips, when AI growth is infinite, becomes AI growth is expensive, those models don't hesitate. They don't care about your mortgage. They don't care about layoffs. They don't care about timing a sell so the market can digest it. They respond. And if enough of them respond together, they don't just react to the market. They become the market, which creates a terrifying possibility. The next crash might not be triggered by humans deciding to panic. It might be triggered by machines, deciding to protect themselves in perfect unison. But automation is only half the story, because even a fast crash needs something else to become systemic. A belief that the system is safe. That belief is manufactured by black boxes. Think about the last time the world was sold safety. It wasn't sold as risk. It was sold as innovation. In the 2000s, Wall Street's magic trick was securitization. Mortgages became bonds. Bonds became slices. Slices became rated products. And ratings became a substitute for understanding. To the person buying a supposedly safe mortgage bond, the story was risk has been diversified. But the Financial Crisis Inquiry Commission, looking back, described a more brutal reality. Policymakers and regulators did not have a clear grasp of the system, in part because of a lack of transparency in key markets. They thought risk had been diversified when, in fact, it had been concentrated. That one line is basically the epitaph of 2008. Now here's why AI should make you uneasy. AI is the perfect machine for manufacturing the feeling of diversification. You feed it more data than any human can process. You watch it output confident probabilities. You put that output inside dashboards, or trading strategies, or risk systems. And suddenly the people in charge believe they understand risk, because the model produces numbers. This is not a new mistake. It's a rebranded one. The near failure of long-term capital management in 1998 is a classic. LTCM's downfall wasn't bad math. It was math applied to a world that changed, amplified by leverage. A U.S. Treasury report on the LTCM episode warned that excessive leverage can transmit problems at one institution to others and increase the likelihood of a general breakdown in the functioning of financial markets. Models don't cause crises by being evil. They cause crises by being believed. Now add AI, and you add two things that are historically correlated with disaster: opacity and scale. Opacity, because modern AI systems, especially deep learning, can be difficult to interpret and monitor. Scale, because once an AI system is deployed, it can influence decisions across millions of accounts instantly. Regulators are staring right at this. In 2023, the U.S. SEC proposed rules specifically to address conflicts of interest associated with predictive data analytics and similar technologies explicitly, including AI that optimize for predict, guide, forecast, or direct investment-related behaviors. The SEC warned that because these technologies scale and can reach broad audiences rapidly, conflicts of interest could harm investors in a more pronounced fashion and on a broader scale than previously possible. That's polite regulator language for a dark idea. Your brokerage app can become a persuasion engine. Your feed can become a funnel. Your recommendations can become nudges. And if those nudges are optimized for the firm's interests, more trading, more fees, bigger spreads, then the most advanced machine in your financial life might be working against you while smiling. The Financial Stability Board went even further and called out the fraud angle. It warned that Gen AI increases the potential for financial fraud and disinformation in financial markets, which, if you think about it, is obvious. A system that can generate convincing text, audio, and video at scale doesn't just write emails. It writes lies. It can impersonate executives. It can flood markets with fake narratives at speed. It can weaponize the very thing bubbles run on attention. So the fifth crash pattern is this: the rise of a black box authority. In 1929, it was the authority of the market and brokers offering margin. In 1999, it was the authority of analysts and the myth of the new economy. In 2008, it was the authority of ratings and engineered diversification. In the AI boom, the authority is the model. And once the model becomes authority, it becomes very easy to do two things at once: take on more risk and feel safer doing it. Now let's put all 5 patterns in the same room and see what kind of monster they build. You can think of a modern crash like a controlled demolition. Not controlled by a single person, controlled by incentives. First, you stack the pillars. Then you weaken the joints. Then you wait for a small shock that tests the structure. And if the structure was built on synchronized assumptions, the collapse looks sudden. But it was engineered slowly. The AI boom has stacked 5 pillars that history has repeatedly punished. A myth of a new era. Concentration disguised as diversification. A building spree that hardens optimism into contracts. Automation that turns fear into instant action. And black box authority that manufactures safety while hiding risk. But there's an extra ingredient in the AI era that makes the whole thing feel eerily like a systemic event waiting for the right spark choke points. The AI economy is not decentralized. It's a funnel. The most advanced chips that make modern AI possible don't come from 100 factories. According to Wired, TSMC produces at least 90% of the world's most advanced computer chips. The machines needed to produce those advanced chips are even more concentrated. Investopedia has described ASML as the sole, global supplier of extreme ultraviolet lithography, machines the EUV tools required for cutting-edge chip manufacturing. And the computing that runs large-scale AI isn't spread evenly across 1,000 neutral providers. Synergy Research has reported that in large-scale cloud infrastructure, the big 3 providers, Amazon, Microsoft, Google collectively hold more than 60% of the market. Do you see the shape of it? One company dominates advanced chips. One company dominates the machines to make advanced chips. 3 companies dominate the cloud capacity where AI is trained and deployed. That's not a free market. That's a narrow bridge. And bridges don't have to collapse to create panic. They only have to wobble. This is what regulators mean when they talk about third-party dependencies and service provider concentration. A choke point is where the whole system becomes one big correlated bet. Now layer on the physical bottlenecks. The IEA says data centers already consume hundreds of terawatt-hours of electricity and could roughly double consumption by 2030. It also warns that the broader energy system takes longer, lead times to build, than the tech industry takes to deploy data centers. So you get a situation where the AI boom is not just a digital story. It becomes a race against grids, permits, transformers, energy prices, and that's before you add the security dimension. In its discussion of energy and AI, the IEA notes cyber attacks on energy utilities have tripled in the past 4 years and become more sophisticated because of AI, while AI is also being used as a defense tool. Again, narrow bridge, heavy traffic, rising risk. So what does a crash scenario look like in this world? It doesn't start with AI is fake. It starts with AI is expensive. Maybe it starts with a simple accounting reality companies spent enormous capex, but the revenue doesn't scale fast enough. Free cash flow starts to sag. Investors notice. Maybe it starts with price wars in cloud AI. If everyone can offer AI assistance, margins compress. The dream of infinite pricing power meets competition. Maybe it starts with a bottleneck energy constraints, chip shortages, export restrictions, a data center build that runs late, a regulatory crackdown on AI disclosures, or a cyber incident that erodes trust. And then, because markets are concentrated, the disappointment hits the same handful of names everyone owns. Passive funds rebalance automatically. Risk parity systems react. Quant funds adjust exposures. Options hedging flips into forced selling. Liquidity thins like it did in 1987, like it did in 2010. Suddenly, the market isn't a debate. It's a cascade. This is the part where everyone asks, how could this happen so fast? But the speed isn't surprising anymore. We've been practicing. The Brady Report showed how a small number of institutions, following mechanistic models, can produce outsized selling pressure, create dislocations between linked markets, and frighten away human buyers, turning a decline into a free fall. And the IMF is explicitly warning that AI may increase speed and volatility under stress, especially if models behave similarly. Now, I need to say something carefully, because this is where people drift into conspiracy. There does not have to be a mastermind. A crash is just mass coordination without a coordinator. It's the invisible hand trembling. So who pays the price when that happens? Not the people who wrote the first bullish thread, not the people who got the IPO allocations, not the executives who exercised options near the top. The bill gets delivered to the people who never opted in. If your pension is market-weighted, your retirement becomes a concentrated AI bet. If your job is in a company that sells into tech, CapEx cuts become layoffs. If your rent is already tight, a recession turns tight into impossible. And if your local government built infrastructure expecting a data center, boom power lines, water systems, tax, incentives, then a slowdown turns those promises into budget pain. This is the dirty secret of financial crashes. They start in the richest rooms, and they finish in the poorest neighborhoods. But the AI era has an additional cost that doesn't show up on stock charts, trust. Because as Gen AI scales, it can scale fraud. It can scale disinformation. It can scale synthetic persuasion. The FSB has warned about that potential explicitly. In a stress event, narratives matter. Rumors become runs. Confidence becomes liquidity. Now imagine that environment, but filled with machine-generated proof, machine-generated leaks, machine-generated official statements that are not official at all. A modern crash could become a crisis of epistemology, people. Not just losing money, but losing the ability to agree on what's true. And that's when finance stops being an economic story and turns into a political story. So the question in the beginning, what if the next crash starts with a machine, is not science fiction. It's a question about incentives, concentration, and automation, about building a system that behaves the same way across time, regardless of the technology inside it. Now, let's close the loops. What are the 5 ways AI is repeating the biggest crashes? First, the new era story. People stop pricing companies and start pricing destiny. Second, concentration. The market becomes a handful of firms. Third, the building spree. Optimism turns into capex, debt, and irreversible commitments. Fourth, automation. Selling becomes instantaneous, synchronized, and indifferent to price. Fifth, black box authority. Risk looks diversified, but it's concentrated, and the model makes it feel safe. If you only remember one thing, let it be this. Technology changes. Human incentives don't, and the market is not a moral judge. It's a machine for converting belief into price and price into pressure. So what's the exit door? It isn't avoid AI. That's not realistic, and it's probably not even smart. The exit door is learning to spot fragility before it tells you it exists. When you hear this time is different, treat it as a smoke alarm. When diversification looks effortless, check whether it's actually concentration. When investment turns into an infrastructure arms race, ask what happens if demand grows slower than the debt. When decision-making is automated, ask what happens. When the models all see the same threat at the same time, and when a black box says, "Trust me, demand to know who benefits if you do." Because the dark side of capitalism isn't that progress happens. It's that progress gets financialized. And when ideas get financialized, they get weaponized against anyone who can't afford to exit before the crowd does. If you want to see where this story might go next, don't look at the next AI model announcement. Look at the choke points, the chips, the lithography machines, the power grids, the cloud contracts. Because the next scandal, the next crisis, the next crash catalyst is almost never where the hype is loudest. It's where the dependency is quietest. And in the AI era, dependency is the real currency. And if that felt a little intense good, it should. Because the most dangerous moment in a boom is the moment you stop feeling intensity and start feeling normal. That's when the new era stops sounding like a hypothesis and starts sounding like the weather, like something that just happens to you. Let me end where we began, that 2010 market event, where a machine sold 4.1 billion of futures without regard to price or time. People remember it as a weird glitch, a freak day, a ghost in the server racks. But the deeper lesson is uglier. The system didn't break. The system behaved exactly as designed. When liquidity thinned, automation didn't slow down. It sped up. When humans would have hesitated, automation executed. When the market needed judgment, it got throughput. Now, imagine the next glib explanation after a future crash. It was an unpredictable combination of factors. There was a sudden shift in sentiment, a technical dislocation. You've heard those phrases before because they're useful. They let the people who profit from complexity pretend. The complexity has no authors. But complexity always has authors. And in the AI era, the authors are not just bankers and executives. They're also engineers and product managers and platform incentives and regulators, trying to catch up with a system that moves faster than reporting cycles. The IMF and the FSB both stress that AI adoption is moving quickly and that monitoring and data gaps make it hard to see vulnerabilities in real time. So if you want to protect yourself not with panic but with clarity, the question is not, will AI change the world? It will. The question is, what happens when the people who own the choke points decide the price of the future? Because that's where the next investigation lives. In the next episode, I want to track the AI empire. The way you'd track a cartel, follow the supply chain. Choke points, follow the cloud contracts, follow the energy bottlenecks, and follow the quiet political deals that decide who gets compute and who gets cut off. If AI is the new oil, then compute is the refinery. And right now, the refinery is controlled by a small number of gatekeepers. That is not a moral judgment. It's a map. And once you see the map, it's hard to unsee it. Because the dark side of business is rarely a single villain in a suit. It's a system that rewards the people who build dependencies and punishes the people who have to live inside them.